Okay, today we're going to talk about stockholders' equity. We have the assets, we have liabilities, and we have stockholders' equity. Up to this point, we've really kept it simple with stockholders' equity. We said there was two primary accounts: common stock, which sometimes is called capital stock, and retained earnings. Retained earnings is where everything flows into in terms of revenues, expenses, and dividends. So retained earnings is the earnings we've earned year after year after year that have not been given back as a dividend. Okay, and so sometimes it's called accumulated earnings. Well, now we're going to introduce several new stockholders' equity accounts. And there's a lot of little detailed stuff in this chapter. There's no one major area like in long-term liabilities. We saw bonds payable. So it's just a lot of little stuff here. So we'll cover that stuff. Okay. Early on, we talked about the benefits of incorporating, and the big benefit is what's called the limited legal liability. So if you own a business that's a corporation and you get sued by a customer for some reason, they can sue the business, but they can't go after your personal assets, and that's an important aspect of incorporation. Okay, so the limited legal liability, whereas if you were a sole proprietor or a partnership, they could sue you for your personal assets because you and the business are considered one and the same. A corporation is a separate legal entity. It's also a separate tax entity. You fill out a corporate tax return at the end of your business year. We buy and sell shares of stock. We know corporations are either privately held, which is like a family business, or they're publicly held or called publicly traded because you and I can buy and sell shares of stock whenever we want in these companies. Simply open up a brokerage account, have sufficient money in there, and you can be in and out of a stock in 5 minutes if you want. Okay, and so very easy to transfer ownership, and this has facilitated the ability for big companies to raise large amounts of money. Capital's a fancy word for money. Okay, the downsides, if you want to call it that, is that you definitely have more government regulation in terms of paperwork and forms, and especially if you're publicly traded, the SEC. There's an awful lot of reporting requirements to the Securities Exchange Commission. And there are some additional taxes associated with dividends, but most companies at some point in time will incorporate for the limited legal liability protection. All right, so let's start by talking about common stock. Okay, when we start our business and we file our articles of incorporation and our business charter, which are kind of comparable terms, and we establish the operating rules, what they call the bylaws of the company. Not stuff that you don't really have to worry about in this class, more business law stuff. One of the things we have to do is we have to request that a certain number of shares be authorized so that in the future we can then issue or sell those shares to people to raise money. Those people that we sell the shares of stock to become owners of the business and they invest their money. And we call that paid in capital or contributed capital or even invested capital. But on the balance sheet in the stockholders equity section, you'll frequently see the paid in capital section. That just means money that was invested in exchange for shares of stock. Okay, so the greatest number of shares that we'll have are those shares that are authorized, but we don't have to sell every share that's authorized all at once. So for example, we may authorize 500,000 shares or 5 million shares or whatever. I mean, Microsoft has 10 billion shares out there. Okay, just because you have 1 million or 10 million shares doesn't give the stock any value. What gives the stock value is how your business is doing, the assets and the growth, revenue, profitability, etc. Okay, so we get the shares authorized by the state when we file our articles of incorporation, and we will then issue those shares of stock in exchange for money. We're raising money. We call that equity financing. Okay? And initially, those shares of stock that our investors now have in exchange for their money are considered to be both issued and outstanding. In just a little while, we're going to see sometimes shares can be issued but not outstanding. But when we first issue those shares of stock, they're both issued and outstanding. Okay, so in our example, let's assume we authorized 50,000 shares, or we requested the state to authorize 50,000 shares, and they granted it. We don't have to sell all 50,000 at once. So we issue 10,000 shares of stock for $10 per share. Now, let's read this together. 10,000 shares of $2 par value common stock for $10 per share. We need to talk about these two different numbers. First, $2 par value. What is this par value? This is a concept that's been out there for a long time, and we have to account for it. Many states no longer require a par value. The concept of par value has to do with legal capital, which you see on the screen there. Par value of each share times the number of shares issued equals something we call legal capital. Legal capital is an amount within the stockholders' equity section that has to stay in the business. The owners are not allowed to withdraw any money in legal capital, and it's there for the protection of creditors, because we have this limited legal liability. So the laws from the old days said, well, you have to have at least a certain amount, kind of like a reserve within the equity section, that the owners can't touch until after all liabilities have been satisfied in the event that the business liquidates. Okay, and so legal capital equals par value per share of stock times the number of common shares outstanding. Okay? And so we establish a value per share that we're not allowed, we, the owners, are not allowed to withdraw from the company. It has to stay within the company. Okay? And we call that par value. All right, now the problem with the concept of par value is that the laws allow each company to establish whatever that par value is to be per share. And nowadays, most companies establish par value at a penny a share, a half penny a share. A lot of companies, par value is 1/10 of 1 penny per share. And so the reality is, it doesn't really create much of a reserve for the protection of creditors. They kind of undermine the rule, the concept of the rule. However, we still have to account for it. As far as you're concerned, the accounting student, you simply have to know that when we issue stock, we're going to sell it at market value, which will always be higher than par value. So in our example, the market value is $10 per share, and we're going to raise $100,000. You multiply 10,000 shares times $10 market price per share. That's $100,000. Debit cash for $100,000. I'm going to credit the common stock account, and make note, that's my legal capital. Number of shares issued times par value per share. And I'm going to credit common stock for $20,000. Again, that's my legal capital. And then the remainder, because remember, I raised $100,000. The remaining $80,000 goes into a brand new account that is called either paid in capital in excess of par value. And I know that's a lot of words there, but if you dissect that long name, it is very descriptive. It's paid in or contributed money that exceeds par value. So let's just break that number 80,000 down. If I sold each share of stock for $10 per share, and the par value is $2 a share, then $8 per share is in excess of par value. Paid in capital in excess of par value, this account, which is a stockholders' equity account, is more commonly called additional paid in capital, APIC. That's what we have on the screen here. So we're going to credit, because this is a stockholders' equity account, APIC, which is additional paid in capital, also called paid in capital in excess of par value. Okay, so depending on what your book says, it's the same account. And we're going to just designate it as relating to common stock, since when we look at preferred stock in a little while, it can also have an APIC account. And again, these are stockholders' equity accounts. So from my accounting equation standpoint, my assets, cash, increased $100,000. Stockholders' equity also increased $100,000. The journal entry, debit cash for $100,000. Credit common stock for $20,000. That's our legal capital. We're not allowed to withdraw that money. And then we have additional paid in capital, which is a stockholders' equity account. And the owners, if they had to, they could withdraw that money. Typically, when we pay a dividend, it comes out of retained earnings. But sometimes a company will pay what's called a liquidating dividend, which is when we debit the APIC account. Okay, and that's when we've either ran out of retained earnings or we're designating a special dividend as a liquidating dividend. Okay, onward. So we have this journal entry. If we had issued the stock at the same price as par value, we would simply debit cash, credit common stock. But all the time, literally, market value will exceed par value, and this is the journal entry we're going to see. The numbers may be different, but we're always going to debit cash, always going to credit common stock, always going to credit APIC for the difference between market value and par value per share. Okay, now, we also have something called Treasury Stock. This is another new stockholders' equity account. Let's go ahead and just read the slide together. Treasury Stock is a contra equity account. Okay, here comes another contra account. Contra means opposite. If equity has a normal credit balance, then a contra equity account is going to have a debit balance. Okay, Treasury Stock is a contra equity account. It has a normal debit balance. Okay, we find it in the stockholders' equity section. Okay, and it reduces the value of stockholders' equity. It has nothing to do with the U.S. Treasury. Treasury stock for any company is when they buy back from the stockholders a number of common shares that had been previously issued. Now, why would they do that? Most commonly, it's when the stock market price has gone down and the officers and the board of directors of the company believe that their stock price is lower than it should be. Okay? In the stock market, sometimes due to speculation and everyone getting excited about an investment, they push a stock value higher than it should be, and sometimes a stock gets pushed lower than it should be. So sometimes when a company believes that their stock price is lower than it really should be based upon the company's performance, assuming they have sufficient cash in the bank on their balance sheet, they will buy back their own shares of common stock, and we call that treasury stock. And the journal entry is simply to debit treasury stock and credit cash. Now, here's the thing about treasury stock. It's still considered to be issued, but it is no longer outstanding. Okay? In order for stock to be outstanding, or really issued and outstanding, it has to be in the hands of the stockholders. So a company buys back shares of stock. Now, a company cannot own itself. What's happening is this is a partial and intentional liquidation. Doesn't mean they're going out of business, but watch what happens. When cash goes down, equity goes down as well. The balance sheet has just gotten smaller. So when we buy back treasury stock, equity goes down, we debit treasury stock. It's a reduction of stockholders' equity, and we credit cash, and cash goes down as well. In our example, we bought 5,000 shares of our previously issued common stock for $8 each. So we debit treasury stock 40,000, credit cash 40,000. Now I'm going to go back to the previous slide. We had issued 10,000 shares. We still have 10,000 shares issued, but because we bought back 5,000 shares, there's only 5,000 shares outstanding at the moment. We are allowed to reissue those treasury shares that we just bought back. We're allowed to reissue those in the future if our stock price rises and or if we need to raise additional money. So they're still considered to be issued, but because they're not in the hands of stockholders, they're not outstanding. And this is when the number of shares issued will be more than the number of shares outstanding. Okay? And so when we have treasury stock, shares issued will be greater than shares outstanding. If we had no treasury stock, then issued and outstanding would be the same number. Okay? And we'll report treasury stock at the bottom of stockholders' equity, where we'll reduce stockholders' equity. We'll see an example of a stockholders' equity section in just a little bit. And we also have another type of stock called preferred stock. Okay? Now, preferred stock allows a company to raise money without diluting the voting power of its existing common stockholders. You can think of common stockholders as the real owners of the business. Preferred stock is non-voting. They don't have any voting rights. And preferred stock kind of looks and feels like a note payable or a bond payable, but with the important legal distinction that it's not debt but equity. Therefore, if we're in hard financial times, we don't have to pay them their dividend. Whereas if this were a bond or a note, we have to pay that interest. Okay? That gives us an important amount of flexibility. We don't want to be in that position, because if we don't pay our dividend, the stock prices are going to go down. That's a sign of distress, but we're not going to be forced necessarily into bankruptcy. Okay, so preferred stock, which also has a par value, and par value for preferred stock is usually larger, and you'll usually see it in the books at like $50 par value per share or $100 par value per share. And it pays a fixed dividend, and that dividend is usually stated as a percentage, 6%, 7%, 8%. So for example, if I had a $100 par value preferred stock and I was paying an 8% dividend, I multiply par value times 8%, so 100 times 8%, I pay an $8 dividend per share. Okay? If I issued 1,000 shares of preferred stock, 1,000 times $8 per share, each year I'm supposed to pay an $8,000 dividend. Okay? The reason they call it preferred stock is for two primary reasons. First, preferred stockholders have to receive their dividend before any common stockholders receive dividends. Okay, so they have preference over the common stockholders to receive their dividend. And second, in the event that the company liquidates, they sell off all their assets, convert to cash, pay off all their liabilities, then the preferred stockholders will get their investment back before common stockholders. So in the event of an involuntary liquidation, generally speaking, any stockholder is going to come out in bad shape, because when there's an involuntary liquidation, typically liabilities exceed assets. Okay, the company's in trouble. And so the pecking order, if you will, is secured creditors, people we owe money to, liabilities, who have collateral, whether it's real estate, inventory, equipment, etc. They get their money back first. Then you have unsecured creditors who don't have any collateral. Okay, these could be your vendors, your employees who are owed wages. Okay, then they're next in line. Then you have the preferred stockholders who should get their money back, assuming the creditors have been satisfied. And at the very bottom are the common stockholders. They're last in line, and they're last to get their investment back. So we call it preferred stock because they get their dividend before common stockholders, and in the event of liquidation, they would get their investment back too. Okay? Now, preferred stock can have features or characteristics to it if the company so chooses to offer these characteristics or features, such as it can be convertible. Convertible preferred stock can be converted into shares of common stock. Okay, that's a nice feature for an investor to have. And on the bottom of the slide here, sometimes preferred stock is called cumulative. Okay, and that's a nice feature, because what that tells the investor is in any given year, if for whatever reason the company is unable to pay them that annual dividend, they're going to make it up to them in the future. They're going to say, look, we have like an informal IOU, and those dividends that we should have paid you this year but we couldn't, we call those dividends dividends in arrears. In arrears. Now, who knows where that term came from? But what that means is we're going to keep track of those dividends. It is not a liability that will go on the balance sheet, but we will disclose it in a footnote in the financial statements. Okay? So again, it's not a liability. Don't have to record a liability, but it's an informal IOU, and before we pay any current year dividends to either preferred stockholders or common stockholders, we would pay any dividends in arrears. Okay? So if we pay off any dividends, old dividends that from previous years, which are called dividends in arrears, then we pay the preferred stock current year dividend. Then if there was anything left, common stockholders would get a dividend. Okay? So if you have cumulative preferred stock, any dividends that are not paid this year will be paid in a future year. Sometimes preferred stock is non-cumulative, and that means if we don't pay a dividend this year, you're out of luck. Better luck next year. Common stock is always non-cumulative. It's never cumulative. Okay, so if we don't pay a dividend this year, you don't get a dividend. Okay, speaking of dividends, let's talk about dividends. Cash dividends is what we're going to focus on. I'll mention stock dividends briefly. Don't worry about property dividends or other types of dividends, scrip dividends. Don't worry about that stuff. Cash dividends. We need to know 3 important dates from an accounting standpoint. First, we call it the declaration date, and this is when the board of directors announces that they're going to pay a dividend. In order for any company to pay a dividend, the board of directors has to authorize that dividend. You obviously have to have a sufficient amount of cash, and you have to have retained earnings. Okay, remember, you can borrow money and have cash, but not have retained earnings. So dividends almost always comes out of retained earnings. So on the declaration date, the day that we announce publicly that we're going to pay a dividend, we'll pay it within a few weeks or a couple of months at most, that creates a liability that we have to record. Debit dividends, or we may just debit retained earnings. And remember, the dividend account is a temporary account. It gets closed out to retained earnings. So it eventually ends up in retained earnings. So in some textbooks, they simply debit retained earnings. Okay, in our case here, we're going to debit the dividend account, okay, and we're going to credit dividends payable. And dividends payable is a current liability, since we're going to pay that within a few weeks or a couple of months at most. That's the declaration date. The second date is the record date, or date of record. And that, there's no journal entry here, but it simply means you have to have owned that stock on that day in order to receive the dividend that we just previously announced. So the record date or date of record says you need to own the stock on that day if you're going to get this dividend. If you buy it after the record date, you don't get that dividend. You would get any future dividend. And third, we have the payment date, which is pretty self-explanatory. It's when we actually cut the check for the dividends. When we pay any liability, you debit the payable, in this case debit dividends payable, and you credit cash. Okay? So ultimately what's happening is when you pay a cash dividend, your assets, cash, are going down, and equity, retained earnings, is going down. Okay? And it's kind of like Treasury stock in that it's it's like a partial and intentional liquidation of the company. Okay, but again, it's intentional. It's usually an indication that they had a profitable year, and they're simply giving the owners some of that money back, and they'll reinvest the remainder. Okay, well, I shouldn't say you never, but more often than not, you only give part of this year's income back, and then you reinvest the rest. In the early years of a growing business, they usually don't pay dividends, and they reinvest all profits back into the business. Once the company starts to hit what's called the maturity stage, and typically with a publicly traded company, that means their stock price is no longer growing at an accelerated pace. It's starting to taper off there, if you will. That's when they typically start paying dividends. Okay? And they start to attract a different investor, a more conservative investor who likes the periodic inflow of cash. A lot of retirees and older investors like stocks that pay dividends because they like the cash flow that comes in, whether it's once every 3 months, 6 months, or once a year or so. Okay? So we have 3 dates. The declaration date, when we announce we're going to pay a dividend, that creates the liability. The record date, the day you had to own the stock on. No journal entry for that record date. And then the payment date, when we actually cut the checks and we reduce the liability, credit cash. Okay, so assets go down, equity goes down when we pay a cash dividend. Some companies, typically companies that are still in the growth phase, will pay a stock dividend. Okay, now a stock dividend is different than a cash dividend. We're not giving them any money. We don't really have the money to give them back. We need to reinvest that money back in the business. But what we're doing is we're saying, look, we want you to stay as investors, as stockholders. We're going to give you a few additional shares. And as the company grows and profits increase, our stock price will increase. And you will now have more shares of stock that are increasing in value. So a stock dividend is a good thing for the stockholders, but on the day that we issue the stock dividend, it doesn't really affect the value of the company. With a cash dividend that we just previously saw, cash, assets went down, equity went down. With a stock dividend, what we're doing is we're going to take the value of the shares of stock out of retained earnings, and we're going to put it in the common stock account and the APIC common stock account. So we're rearranging the stockholders' equity section when we have a stock dividend. But what's happening is our accounting equation isn't changing. We're just rearranging some equity accounts over here. But assets and liabilities unaffected, and within stockholders' equity, retained earnings went down, but common stock and APIC common stock went up, and they offset each other. So total stockholders' equity stays the same with the stockholders' dividend. Okay? But it's still considered good for stockholders because, again, they now have more shares of stock, and if the stock goes up, $2, $3, $4 a share, they have that many more shares that increased $4 a share. So it's a good thing. Okay? And don't worry about the journal entries for a stock dividend. Stock splits. Have to give a little bit of historical background to appreciate stock splits. They're not quite as common these days, but prior to trading over the internet and all the competition that set in when we had all these online brokers, people used to buy and sell stock in what they called an even lot of 100 shares or 200 shares or 300 shares. You didn't trade in odd lots. An odd lot is something other than 100. It might be 75, 37, 63 shares. Okay? You can do that these days without being penalized because of the amount of competition out there. But in the old days, when you picked up the phone or you spoke to your broker in person, you bought and sold 100 or 2, 3, 4, 500 shares in an even lot of 100. As a result, let's say, for example, that a company's stock is currently trading for $100 per share. Okay, this is the market value or market price per share. If you bought the lowest even lot possible, you would have bought 100 shares, and that means you would need $10,000. That's a lot of money for most people. And 20, 30, 40 years ago, it was considerably more money. And so when a company's stock started to get into the, the 80s, the 90s, hundreds, 110 range, they would say, okay, we may see a drop-off in some of the demand for our stock, since in order for them to buy shares of stock, they would need to buy 100 shares or more. That's a lot of money. So what they might do is they might do what's called a 2-for-1 split. They might do what's called a 3-for-2 split, or even a 4-for-1 split, a 5-for-1 split. There's lots of different ways you can split stock, but the most common is a 2-for-1 split. And what they're saying is, if you had purchased 100 shares of stock that had a market price of $100 per share, after the 2-for-1 split, you would now have twice as many shares, so you'd have 200 shares, but the market price would be cut in half. So it would be $50 a share. Notice, 200 times 50 is still $10,000. So the value of your investment didn't change, but now if a new investor wants to buy 100 shares, it would only cost them $5,000 instead of $10,000. And so stock splits were created to stimulate investment in stock and stimulate trading, okay? And investors, generally speaking, like stock splits because it usually occurs when a stock price is increasing, and stock increases when a company is doing well. You can have something called a reverse stock split, and that's the opposite scenario. Stock price is decreasing in value, so they double the value, but you now have half the number of shares. Okay, and it's really for psychological purposes, so their stock value looks like it has a better value than it did before the split. We're going to focus on a 2-for-1 split, okay, but whether it's 2-for-1, 4-for-1, the rule is you need to know 3 things from an accounting standpoint for a stock split. First, if it's a 2-for-1 split, we cut the par value per share in half. If it was a 4-for-1 split, we divide it by 4. 2-for-1 split, we divide the market price by 2. As we just saw, $100 a share now became $50 a share, but you had twice as many shares, and you double the number of shares outstanding. Okay? And again, this was done pre-internet when trading shares in 100 or 200 started to get prohibitively expensive for many investors, for the smaller investors in particular. Okay? So notice, a split does not create additional value at the time of the split, but over time, if the stock value increases, you now have twice as many shares that are increasing in value. So people like stock splits. They're usually considered to be a good sign. Okay? And so you simply know there's no journal entry for a stock split. Simply on a 2-for-1 split, cut the par value in half, cut the market price in half, and double the number of shares. If it was 4-for-1 or 5-for-1, instead of using 2, use the numbers 4 or 5. Very simple. Okay, here's an example of a stockholders' equity section. Okay, and notice the first section for stockholders' equity is called paid in capital, and these are the contributions that were made by the investors in exchange for shares of stock. It wasn't earned by running the business, it was an investment. So the paid in capital section of the stockholders' equity section is either called paid in capital or contributed capital or even invested capital. But it's the money the investors put into the business to fund the business, okay? And within the paid in capital section, we would have, in this example, we have preferred stock, and let's just take a look at this. 9%, that's the dividend, which is based on par value. The par value is $100 per share. It's cumulative, that's a nice feature. 10,000 shares authorized, 6,000 shares issued and outstanding. Okay? And so notice, we credit the preferred stock account, number of shares issued times par value. And if you notice a little further down, we have additional paid in capital for preferred stock. So the market price was actually a little bit higher than the par value. So we list preferred stock. Underneath it, we have common stock. Now, let me just make a quick comment. In this particular example, capital stock refers to all types of stock. Okay, as far as you're concerned, that's not that big a deal. Okay, we have two primary classes of stock, which we're going to call common and preferred. Okay, now after the preferred stock, we have common stock. No par with a $5 stated value. Okay, now I have to mention that. Not all states require a par value. If you're in a state that does not require a par value, you may establish a par value, but we call it a stated value. As far as you, the accounting student, are concerned, if you see no par with a stated value, as far as you're concerned, you simply say, oh, that's the same as par value from an accounting standpoint. Okay? So, common stock, no par stated value, or par value $5 per share, 500,000 shares authorized, 400,000 issued, and 390 outstanding. That tells me that further down I'm going to see 10,000 shares of treasury stock, and we do. Okay, so preferred stock account, plus the common stock account, plus the APIC accounts for preferred and common, that gives me my total paid in capital section. Underneath that, I have my retained earnings. Okay, then I add everything up, and remember, I got to subtract treasury shares, the value of the treasury stock, to get total stockholders' equity. Okay, and in this particular example, they're giving us a little footnote saying that they have a restriction on part of retained earnings. So that means that the restricted retained earnings we can't pay back to the stockholders as a dividend. Sometimes companies will have restrictions, also called an appropriated retained earnings, which means you're setting some money aside either for some sort of future expansion or because a loan provision or loan contract requires it, or in this case, they set it aside related to treasury stock. Okay? So if you restrict or appropriate retained earnings, you simply have to disclose that in a footnote. They put it right here, but typically you'll find it in the footnotes themselves. Okay? So here's what a stockholders' equity section looks like with all the necessary details. All right, the last thing we're going to talk about are financial ratios. The first ratio is called the payout ratio, and it's simply telling us what percentage of this year's net income did the company give back to the stockholders as a dividend. It's in percentage terms. Okay? So cash dividends for common stockholders divided by net income. Okay, for every $1 net income, how many cents were given back to the stockholders? The difference between those two numbers is the amount we reinvested or put back into retained earnings. Okay? So certain investors look at the payout ratio because they're curious as to what percentage of income they can expect as a return per share for each dollar of net income. And then we have return on common stockholders' equity, which I abbreviated ROE, return on equity, but it's implied that it relates to common stockholders. If we have preferred stock, we have to satisfy that preferred stock dividend first, but again, they're non-voting. And the real owners of the business are the common stockholders. So after we satisfy the preferred stock dividend, what's left of this year's profits are really for the common stockholders. Okay, preferred is it's almost like we borrowed money from them, not quite, not from a legal standpoint. Okay, so we give them their dividend, and then we kind of exclude them from the party, so to speak. So return on common stockholders' equity, we take this year's net income, we subtract the preferred stock dividend, and then we divide it by average common stockholders' equity. And let's go ahead and read that asterisk. How do we get average common stockholders' equity? Well, first, total stockholders' equity minus the dollar value in the preferred stock account and minus the dollar value in the APIC preferred account. Subtract those two values from total stockholders' equity, that gives you common stockholders' equity, since we've now excluded the preferred stockholders. Anytime you see a ratio that says average, that means we take the balance at the beginning of the year, January 1st, we add it to the balance at the end of the year, December 31st, divide those two numbers, add it together, divide it by 2, gives you average. Okay, and we do that here. So net income for the year minus the preferred stock dividend divided by average common stockholders' equity, and again, just take total stockholders' equity and subtract the dollar value in those two preferred stock accounts, and that gives us common stockholders' equity. And that tells us, okay, for each dollar of investment in equity, how much of a return do we get? How much profit do we make for each dollar of common stockholders' equity? Okay, and so investors like to look at return on equity to see how's the business doing, how's their investment doing. Okay, and that's it for stockholders' equity.